So let's bring in Stephanie Link, the chief investment strategist and portfolio manager over at Hightower, as well as a CNBC contributor. Stephanie, the ambassador comments were rather telling. I think that this is very much a situation that still has another chapter or two or three. Why are the markets so calm, if I can use that word, about the geopolitical issues happening with nuclear powers?
Well, I mean, I think that anything could happen for sure, Dom, right? But for now, it looks like it is a non-event in the short term. And so what are we as investors to do? Well, we go back to focusing on fundamentals. And while everybody is obsessed about the recession that's about to come and the inverted yield curve, the economy actually has hung in there pretty well. The last couple of weeks worth of data, it suggests that you're running at about a GDP level at about 2%. That's not recession, not now, for sure, anyway. And it's led by the consumer. And the consumer is 70% of the economy, of GDP. And they're being helped by what we've been talking about for a couple of years now, better jobs. And now real income is actually starting to go higher because inflation is coming down, right? So you've seen a better than expected retail sales number a couple of weeks ago. Housing is absolutely on the mend, the best new home sales in over a year. Autos has also picked up in services. We got the PMI services numbers last week that were comfortably above 50. So that's a big part of the economy, and it's an important part. And manufacturing, well, that's not the great part of the economy. But if you talk to companies and not look at kind of the government data that comes out, you actually hear a lot of momentum on the onshoring side of the equation. And so you've got to pick your spots within manufacturing, but it's not all dire. Add it all up, as I mentioned, GDP's hanging in there. I think earnings are going to hang in there. They may not be great, but I think that they will do better than expected. And I think that's what people are focusing on at this point.
How do you reconcile the data in the markets? You reeled off a lot of bullish or more relatively bullish economic data that seems to support this idea that things are okay. At the same time, parts of the interest rate complex and certainly the commodity markets are showing signs that recessions are something to be feared. So where do then investors position themselves between those two forces on either side?
I mean, I think if you look within the manufacturing part of the economy and you look at the commodities, it certainly is mixed. I'm not painting a really rosy picture. But if you look at the PMIs on the manufacturing side, I mean, they've been down below 50 for the last 6 months. So we kind of know that things have slowed down. That being said, some of the regional manufacturing series are actually getting a little bit better. They're still not great, Dom, but they're getting a little bit better. So my suggestion is perhaps we're getting close to the trough in the PMIs. And again, if you listen to what companies have to say, there are certain pockets within the industrials and energy and commodities complex that are doing just fine. There's no doubt the commodities are pricing in or concerned about a recession and a global recession. But that's why I really pay attention to a lot of the various different data points. And we're not off to the races, but we're certainly, at least right now, we're not in a recession. And so I'm looking for fundamentals, good companies doing great things. And especially what's interesting today, Dom, is just all the laggards year to date are actually outperforming versus the leaders, which we know has been technology.